Hey everyone, and thanks for jumping back into the macroverse. Today, we're going to continue our collaboration series. We have David Lin from the David Lin Report. He has his own YouTube channel. He's also fairly active on Twitter. Make sure you guys go follow him there. Links to his social media will, of course, be in the description below and the pinned comment. So make sure you follow him and get the latest on a lot of the moves throughout a lot of different financial markets, as well as some interesting trends in the technology market. David, pleasure to have you here. I went on your channel not too long ago. I'm excited to have you on my channel and talk about what's going on within these markets.
Hey, Ben, thank you for having me. And yeah, I had you on not too long ago. You were fantastic. I love your insights, love your channels. So very honored to be on your show now. Thanks for the invite.
No problem. I'm sure many people are familiar with you. You've been a very vocal person in the space here for quite some time. But I'd like to get your thoughts on a lot of the things going on in the markets, because oftentimes you're interviewing other people. So in this one, I wanna interview you and just get your general thoughts.
Mm-hmm.
The first question I really have for you is more of a broad-based question.
Mm-hmm.
I want to give you the floor to sort of talk about what you think is the most important. But where are we right now within sort of the macro landscape? Because on one side we have people looking at potential recessions here. On the other side we have the stock market not really seeming to care. What's your take on all this?
Yeah, so I'm going to amalgamate a lot of the views from the people I've talked to, my guests, and then insert a few of my own research points. So a lot of these talking points you might have heard already on my show. Some of them may have come from you, Ben, because you're a very smart guy. But yeah, generally, I think we are headed for a recession. I've been getting this question from my friends as well. Are we headed for a recession? And what investments should we buy in preparation for this? And I did a whole explainer video on this myself. But we're headed for, I think, a mild recession. It's not going to be a catastrophic meltdown like some doom and gloomers have been predicting. Not necessarily with me, but I've been seeing this a lot on media. I don't think we're going to get a complete wipeout of the financial system and the banking sector, but I think we are headed for a downturn, and that's defined by a loss in economic activity, a slowdown in consumer spending, and an uptick in unemployment. Let's just talk about the labor market first. We're seeing layoffs now outside of the tech sector. So I was talking to somebody yesterday. He called this the more economically impactful recessions, meaning people that are entrenched in the economy who may find it more difficult to find another job. I'm talking about companies like McDonald's, who over the weekend have announced layoffs. I mean, that's more or less been telegraphed over the last couple of weeks, but they announced it this weekend. And we're going to start seeing unemployment rise, I think, over the next couple of months. Right now, we're at 3.6%, which is historically very low. And the politicians in the U.S. have been citing this number as an indicator for why they don't think a recession is going to come, because it's still at very low levels, historically speaking. But you have to remember that at every single recession in the past, the unemployment rate has been low in the beginning of the recession and climbs throughout. There's been 12 recessions since 1948. We've never had any one scenario where an unemployment rate was already high going into a recession and stayed at an elevated level or come down. It's always been relatively low and then going up. Now, where are we going to go in terms of the unemployment rate? Well, the last time we had a recession was 2020 for 3 months, two and a half months, 3 months. The NBER designated 2020 was as a very brief recession, and unemployment went up to 20%. But that was a very that was like a black swan anomaly. Mm-hmm. Let's not use that as an indicator, because that's never really happened before. And coincidentally, I did a quick analysis on recessions. I'll just share my screen here. So I looked at the last 12 recessions, one since 1948, and coincidentally, the last recession that we had was also the worst on record in terms of GDP loss. Real GDP declined by 8.5%, which was the most on record. So again, that was an anomaly. That it typically varies between 2%, 3% in the Great Financial Crisis to 0 in the late 60s. So 8.5% is not really something that we typically see. Unemployment rose to 20% last time. In 2008, unemployment went up 10%. I think is closer to that range that we'll see, under 10%, but not quite over. And the reason I don't think it's going to be as bad as 2008, let me just share my video again, is because I don't think we're going to have a systemic wipeout of the entire financial sector. I don't think we're going to have a huge contagion event throughout all banks. Now, what we saw in 2008 with the collapse of Lehman was a failure of a lot of the big banks that have lending in a lot of other industries besides what we've seen so far, which is tech and cryptos. I mean, yes, people have said that the collapse of Silvergate and Silicon Valley Bank, in terms of the size of assets involved, were on par, if not greater than 2008. But yes, but you have to remember that the industries involved primarily are tech, which has already been suffering on paper. So I don't personally think there's going to be a huge contagion-wide event. Did I just lose my feed here? Let me just restart that. And I think that generally speaking, it's going to be okay. My webcam failed, so I'll just use this for now until that recovers. Speaking of technological failures, there's one example. But to my point of the economy, there we go, it's back. So yeah, I think we are headed for a recession. Unemployment will take up to, I think, in the 5 to 7% range is the consensus I've heard from analysts. In terms of GDP decline, nowhere anywhere near 8%. I would say maybe 1 to 2% to maybe 3%. The Atlanta Fed GDP Now tracker is a pretty accurate estimate of where GDP is going, so I encourage everyone to check that out. It's still in the positive territory, but it's starting to decline and starting to roll over. And I think we are headed for a mild recession over the next year or two. And most recessions have lasted in the past. Again, going back to my table, the average duration of a recession was 10 months, with the average frequency of about 6.25 years, which means on average a recession happens every 6.25 years. So not ignoring the last one we had. It's been 2 years, but if we completely just ignore that anomaly, we're overdue for a correction in the economy by far, because the last one was 2008, which was 15 years ago. So that's what I think. Broad overview.
No, I appreciate that. I think you covered most bases there. And speaking of the Atlanta Fed, I saw recently they revised their estimate for Q1 GDP down quite a bit. I think they had it at near 3% recently, but I think they even brought it back down to 1.7. And I think we might even be due for another update today, in fact, if I'm not mistaken. But, by the time people are watching this, I think that update will already be out. But I guess the one thing I keep thinking about with these markets is it seems like we're chasing whatever the most recent narrative is, and it's been like this for basically the last year. It was, inflation is crazy and it's only ever going to go up, and we need 75 basis points and 100 basis points and whatever to get it back under control. And then we went into sort of like the soft landing camp, and then we saw inflation come back with the core inflation, and we've just been chasing one narrative after another. And I guess one question I have for you is we've seen inflation start to come down over the last few months. And I mean, headline inflation is down. There are some elements of core inflation and core services ex housing that have remained stickier. Do you think that inflation is still on do you think it's on a downward path if we're getting a recession, or do you think it's likely going to remain stickier far longer than we might otherwise want it to?
Well, I think there's going to be certain elements of inflation that are going to be sticky, like wages, for example, are always more sticky downwards than perhaps commodities. But overall, I think you're referring to the overall CPI index, which is a basket of all goods and services. I think that's going to continue coming down. And I think for two reasons. I mean, I'm not in any one particular school of thought. I'm not advanced enough to label myself a monetarist or a fiscalist or anything like that. But the monetarist view is that inflation is a product of the money supply, and it's a function of how much the money supply has grown. And let's just take that narrative for a minute. The M2 money supply has grown at an unprecedented rate during the pandemic, which broadly, according to the monetarist view, broadly explains why inflation rose to 9.1% was the peak in June of last year. And it's since been coming down because it's perfectly correlated with a decline in the growth of the M2 money stock. If you look at the M2 on the St. Louis Fed, let's just pull that up right now so we can show the audience. M2 money stock. Let me share my screen. If you take, can you see my screen?
Yeah.
All right, so let's take M2. And here we see the nominal level. Let's just take it by percentage change from a year ago. You see this massive drop here? That has more or less coincided with inflation. Actually, I was curious to see if this relationship was a one-off, but actually, if you go back to like the last 40 years, there's been a pretty much perfect correlation between change in the CPI, known as the inflation rate, and change of the M2. So I'm not saying that's a causation, but it is a perfect correlation. So if you consider that this is a leading indicator for inflation, then yes, I think inflation is going to continue coming down, and it kind of makes sense. I mean, with less liquidity in the system, you have less credit available. People are going to spend less. There's going to be less lending from the banks, and there's going to be less money to spend. But the other reason I think inflation is going to come down is really, if you look at, okay, so yeah, the fiscalist view is that the taxes are also responsible for changes in inflation. I'm not too sure about that one, but I will say that the CPI has been coming down partly due to how much the CPI has risen over 2021. And so the base effect is largely responsible for, I guess, a normalization of inflation rates. And with supply chain issues having fixed themselves over the last 6 months, I think that issue has also resolved itself. And yeah, I think inflation is going to come down, not to the 2% target that the Federal Reserve has, but closer to maybe 4%, 5% by the end of the year. We're already at, I think, 6%. So I think the next print's going to be even lower. I've been hearing stagflation fears. I don't think that's going to happen, is my view, because I think we are going to get a decline in inflation. And we are going to get a decline in economic growth. And keep in mind, to answer your earlier question about how inflation performs during a recession, of the last 12 recessions, there has never been one recessionary period where inflation has risen during the course of the recession. So if you were to hold the view that there is going to be recession going forward, which I do, then you should expect a softening in the CPI.
The M2 chart that you showed is really interesting, and I've seen that a lot recently, looking at this sort of like this change in the M2 and how it can be seen as a potential sort of leading indicator on inflation coming back down. So with that in mind, it raises the question, I think, of, is the Fed overdoing it? I mean, you know, if we already have M2 coming down this quickly, and I mean, it seems like things are slowing down within the U.S. economy. We just had the ISM come out, and you know, we've got lots of things coming in below, especially where they were expected to be, and they continue to be in you know, large declines, even in the services sector, new orders, et cetera. You know, is the Fed overdoing it? Because we know the Fed is a more reactionary body than one that predicts. So do you think that there's a risk here of them overdoing it, or do you think that what they're doing is, you know, it makes sense in line with the current inflation readings that we have?
This is a really interesting chart. So to answer your question, yes, I do think they're overdoing it. This isn't necessarily my view, because this is out of the purview of my own knowledge, but I'm quoting somebody I've had on the show many times before, which is Professor Steve Hanke, who is a professor of applied economics at Johns Hopkins University. He was involved in the 90s in reconstructing a lot of broken economies, helping restore price stability in a lot of economies that have been hyperinflating in Eastern Europe, for example. And we can talk about hyperinflation if you like, but his view is that, yes, the Fed is overdoing it. There's no reason to shrink the balance sheet to negative growth territory. Maintaining a growth of 2%, in his view, I think would have been sufficient to bring down inflation. yeah, this is over tightening it, overdoing it, and it's not just in terms of the interest rate going up. What's equally important is the assets, the total assets, the balance sheet of the Federal Reserve, which is what this chart shows. It's been coming down steadily. Interestingly, it's spiked up recently, and a lot of people have said that that's mainly due to bailouts of the banking crisis. Either way, this down curve here, that is overdoing it. The view of Professor Henke is that this chart should have just been flat. Creating this kind of a negative growth, but what we saw was the biggest shock in liquidity injection in history over 2020 and 2021, and now we're seeing the biggest contraction of liquidity in history in a relatively short amount of time. So this extreme is going to cause consequences for economic growth on the downside. And I think they have overdone it. And time will tell how much they've overdone it by, but I think the results will be lower economic activity, recession, at least 2 quarters of negative GDP growth, and much higher unemployment.
Yeah, I mean, it's interesting because the Fed has, I mean, they've raised rates back to 5%, which they haven't been at 5% in an extremely long period of time. And now that we're at these levels, you know, if you look at what the market's predicting for rate cuts, it's very different from what Powell and people at the Federal Reserve have been saying for a long time, and that's that they don't really expect to cut rates this year. You know,
Yeah.
and Powell has said this many times. In fact, it was, I think, the last thing he said at the last FOMC as he sort of begrudgingly walked off stage was that, like, we're not looking to cut rates this year. That's not in their base case. Market doesn't believe him. You know, I mean, the market just simply does not believe him. And it varies as to when rate cuts are being, you know, sort of priced in. But I think it's sort of going back and forth between, like, you know, June or sometime in the summer or in September. Do you think that the market is too optimistic on when these rate cuts are coming, especially if we get a recession? I mean, so I guess it depends on when the recession starts. If it starts in Q2 or if it starts in Q3. But do you think that the market is being a bit too optimistic on when these rate cuts are coming? And if they are, I'd like to know what your viewpoint on how that would affect markets.
Yeah, I think, first of all, in terms of recession timing, we don't really know when a recession hits us until 3 months later,
Right.
usually. So the NBER, the National Bureau of Economic Research, is the body that officially designates recessions, and they usually do it with a bit of a lag. And so even if we're in a recession now, we won't hear about it until a few months later. Very rarely, I think, in the past have we known about it in real time. I remember even in 2008, people were talking about a recession, and, you know, are we going into a recession? People were asking that question as the recession was happening, but we've only known afterwards that that period was already designated a recession. But to your point about the markets being overly optimistic about a rate cut, I think whoever thinks that we're getting a rate cut may be in for a surprise. I personally don't think we're going for a rate cut, and I'm not even convinced that the overall market is pricing that in. I think what they're pricing in is probably just an end of Fed hikes, but not so much a cut. I mean, Jerome Powell and the Fed have been, you know, when they're cryptic about certain things, we can make assumptions, but he's been pretty clear answering a reporter's question. I remember at the last press conference that somebody asked him, "Are you going to cut this year?" And he said no. I mean, that was just, there was no ambivalence there. He just said, no, we're not cutting. The dot plots indicate that as well. It's not just Powell. Most governors don't think a cut is happening this year. And actually, I'm going to show you the CME Fed Watch tool. This changes every hour, right? The probability of a hike or cut or no cut, no change rather. For as long as I can remember, this chart's been pretty accurate. Now, as we approach the May meeting, we're going to get updates for sure. The next one's on May 3rd. And I fully expect this to change. I don't see any indication of a cut priced in. It's right now, markets are leaning towards no change. So an end of rate hikes and perhaps a slight possibility of of an increase. That's actually come down. It was like 40 something percent just yesterday.
Mm-hmm.
So yeah, I think let's check back a little bit closer to May, but I'm not expecting a cut anytime soon. The Fed has usually not cut until a few months into a recession anyway. If you just take a look at past easing cycles, so I don't think it's coming right away. Especially, I don't expect it by June.
It's interesting because a lot of the talking points on throughout FinTwit or on YouTube, whatever, for a long time has been a Fed pivot, right? History shows us that a pivot isn't really a great thing for markets in general, and one of the reasons I suppose is that you'd have to think about what would it take for the Fed to pivot. Like think about how bad things would have to get for them to want to pivot within the next few months, right? Especially considering inflation is so high. Do you think that a Fed pivot would be immediately bullish for risk assets in general, or would it make more sense to still be somewhat cautious, knowing that the stock market has historically gone down after the Fed starts to cut rates?
I think QE would be bullish for stock markets.
Okay.
I mean, it's perfectly possible to have, in theory, QE during a tightening cycle. I don't think that's entirely what they're doing now, but let's take a look at what the Fed has done in prior cycles. So this is the Fed funds chart. If we go back 20 years, let's just stay to the early 2000s, all right? And we had a recession in 2008. We had a recession in 2020. Both recessions coincided with a decline in the Fed funds rate. But and actually, the Fed started cutting rates right before the recession. The recession in 2008 officially started in December 2007. So the Fed's already been cutting rates, whether or not they telegraphed a downturn. I can't remember, but they were already in the process of cutting rates. So it wasn't entirely reactionary to the recession. It already started happening. In 2020, it was purely a reaction to COVID. Now we're entering unprecedented waters because in no prior recession over the last 70 years have we had the Fed tightening into a recession. Now, if you believe that the Fed has one more rate hike, which some people I've talked to believe, then we are tightening into a recession. If you believe that we're done, then that argument doesn't apply. But still, they've been raising rates into the possibility of a recession. And keep in mind, we did have two consecutive quarters of negative GDP decline last year in Q1 and Q2. So the textbook definition of a recession already applied. It's just that the NBER looks at a lot of other things like personal income and retail sales and consumption in order to make that assessment, and they determined that the economy wasn't as bad to warrant calling it a recession. I think your question is, do I think that a Fed pivot would be good for the markets? I think the markets have largely priced in a pause in the rate hikes. And so a surprise pivot would be absolutely good for the markets. And a surprise pivot, I think, would be in June. I think the assumption that the markets are pricing in a pivot by June, I don't think that's entirely true. I think they're pricing in perhaps no hike at all. But a surprise pivot earlier than expected would definitely be positive for the markets. And going back to that chart, let's take a look at when they might pivot, if history is any indication at all. Historically, they've left rates unchanged for at least 6 to 8 months, right? So I don't know that they're going to pivot right away, even if we do get a recession. The unemployment rate would have to spike up to like 10% overnight for them to warrant that decision. Mm-hmm. And I don't think that's going to happen. Keep in mind, the Fed is one of the few central banks in the world that has two mandates: controlling inflation and controlling unemployment. And Chairman Powell was pretty clear in saying in the last pressure that he would need to see unemployment or the labor market soften before he makes any decision to ease monetary conditions. And I think there's been speculation that he doesn't want to make the mistake of past Fed governors, which is to ease too soon, because that could create problems in its own, especially on the inflation front. They're in a tricky place because if they do ease too soon, they run the risk of raising inflation again, which has already been coming down. So they're going to undo everything that they've already done. but if they wait too long, the recession could drag on for longer than expected. So I'm expecting a rate cut possibly by next year, but not this year.
What do you think about, some of the signals coming from precious metals? We've seen gold start to move up recently. I mean, I think it's around 2,000 or so. Silver, I believe, is around 25, and silver recently broke out from this downtrend that it had been in since early
Hmm.
2021. Do you think
Hmm.
that these precious metals that haven't really seen a a true bull market in the sense of what we saw back in, say, like the 70s and what we saw back in, say, like the 2000s, do you think they're on the verge of breakouts that could be sustained for longer, or do you think that this is just going to be another sort of a false attempt, and they're just going to come back down?
So I expect further tailwinds for gold and the precious metals to be sustained over the next coming months. I think the run up in gold and silver, by the way, silver typically follows gold just with a higher beta. So they typically move in tandem. So if we talk about gold, I think the run up in gold has been primarily due to the decline of the U.S. dollar, the DXY. So here's a DXY chart. The DXY and gold have basically held a perfect inverse correlation throughout history, with some exceptions, but usually it's been pretty consistent. The decline in the DXY could be attributed to the fact that the markets have priced in a slower pace of rate hikes, if not an end to the rate hikes altogether, while other central banks around the world are still catching up to that. And I don't think other central banks around the world are done raising rates. And so the interest rate differential is favoring other currencies and not the U.S. dollar, which is why we've seen a DXY decline, which has pushed up gold. I don't think gold is necessarily telepathing anything. And actually, if we take a look, sorry, let me go back to my Excel sheet. I've done this for gold as well. Has gold historically telegraphed recessions? Gold has done very well during recessions. If you take a look at the gold chart that I'm about to show you here, so gold has, in the last, let's say, six recessions since 1980, gold has achieved zero, if not positive returns during the course of every recession. Now, when markets crash, gold tends to crash alongside stocks initially. This was seen in 2008 and in 2020. The reason that gold was able to close in positive, if not zero territory, by the end of the recession is that gold has, in the past two recessionary periods, recovered faster than stocks. But initially, it tends to, as the saying goes, correlations across assets tend to move towards one during big panic sells, and gold is no exception. I don't think gold is necessarily telegraphing a major downturn as much as it is just reacting to the weakness of the DXY. And I want to show you something else that's very interesting. This is the real interest rate. This is the Fed's calculation. If you take the nominal rate minus the inflation rate, it should be in negative territory. But the direction is still the same. The real interest rate has been going up as inflation has come down. The nominal rates stay elevated, inflation's come down, and so nominal minus inflation rate, real interest rate's gone up. Now, this is interesting because the real interest rate and gold have historically held a perfect negative correlation, meaning if one goes up, the other goes down. Usually gold responds to the real interest rate even more strongly than the dollar. Not ignoring this year, the correlation between the real interest rate inverted versus the gold price has been about 95% over the last 5 years. The R coefficient has been 95%. And so this is a very interesting chart for me because for the first time in a long time, we've seen a massive divergence between two variables that have traditionally been perfectly inversely correlated with each other. They've both moved up together. This shows to me that gold could potentially be overvalued in the short term, and we could potentially see a correction to the downside if this divergence were to disappear. I do think that if the dollar continues to weaken, in the sense that if central banks around the world continue to tighten while the Fed pauses, we could see further strength in gold as a response to a weakening dollar. Um, but I do think that we could, once we have a dip, gold could break out to $2,000 again and sustain that level. But I don't think we're going to have a huge breakout to like $3,000 or $5,000 in the next year. I've heard some predictions before, and I don't see that happening.
With the dollar, you bring up some. I mean, the dollar has shown a lot of weakness recently. I mean, really, it's been on a downtrend for several months now, and it also seems like we're starting to see headlines about like the U.S. dollar in general losing its world reserve currency status. Um,
Mhm.
is that something that you see playing out here in the short term, or do you think that some of these headlines are getting somewhat overblown? Which
Mhm.
could lead to I mean, that if they are, that could lead to what you're talking about, a potential move back down in gold, which I guess would be supported on a rally by the U.S. dollar.
Yeah, first of all, I don't think the dollar is losing its status as a global reserve currency in my lifetime. I mean, I'm in my early 30s now.
Mhm.
So let's assume average life expectancy of 78, 79. I've got 50 more years to live. Is the dollar going to lose its status as a sole, not sole, as the dominant global reserve currency in the next 50 years? I don't think so. And the reason is that it has such an overwhelming hegemony right now that you would need to see a massive decline in dollar usage year over the next 50 years for that to even happen. 60% of global trade is conducted in USD, which has come down. Um, since the 50s, but in the 70s. Uh, but no, I think these headlines pop up every time we see a financial crisis. The dollar is going to collapse. The dollar is going to lose its status. I've even seen a headline on some YouTube video: the dollar is going to go extinct. Ask yourself this question, okay? If you were to go to a third world country right now, okay, Latin America or Eastern Europe or Africa, and you needed some cash to bribe the local officials with, and notwithstanding the local currency, what are you bringing? Are you bringing the yuan with you? Are you bringing the euro with you? You might bring some gold coins and silver coins. I mean, that's always useful. But for bribery money to get myself around, I would bring the greenback, and that's recognized everywhere in the world. That's not the definition of a reserve currency, but it comes to show the confidence in the U.S. dollar all throughout the world. These headlines that the U.S. dollar is going to collapse and we're going to lose value. The DXY is still at the strongest it's ever been in the last 20 years relative to other currencies. All throughout the last 20 years, I've been hearing the dollar is going to collapse. It's not going to collapse anytime soon. The dollar is going to show some short-term weakness because of interest rate differentials, but it's not going to lose its status as a currency of widespread usage over the next few decades. And we're seeing headlines pop up of countries like Brazil transacting in currencies other than the U.S. dollar with a trade partner. We're seeing headlines like Saudi Arabia and China striking deals with buying oil rather, in currencies other than the U.S. dollar. Russia and China are conducting trade in. Okay, yes, that's fine, but how much of that trade is what is the percentage of that trade done across borders in these countries relative to total global trade? It's not a significant amount. And furthermore, the countries have been transacting in other currencies besides the US dollar amongst themselves forever. I mean, not every single cross border transaction has to be done with the US dollar as an intermediary. So I think these headlines tend to focus on the outliers, not the norm.
No, I think that's a fair statement. Do you
Yeah.
what about so yeah, I mean, with regards to the dollar, I agree. It seems like things are getting somewhat overblown. What's your take on one of the more risky asset classes, crypto? Because
Hmm.
we touched here on stocks. We talked a little bit about gold and silver and the U.S. dollar currency index, but there's this other asset class in crypto, and obviously Bitcoin is sort of the one that leads. And it's over the last 5 months or so, it's moved up from around 15K all the way up to 29K or so. Is
Hmm.
this with Bitcoin sitting at 29K? is this a level that you think it can break through as we sort of inch closer to a recession, or do you think it's going to provide some resistance? I'm very curious, like what your view is in general on Bitcoin beyond just a short term price action, because no one really knows what's going to happen tomorrow. But
Right.
how do you see Bitcoin holding up in a potential recession? I mean, we talked earlier about, it seems like we're heading for
Mhm.
one. At what point we get in one, we don't really know. But assuming we get in one, what do you think? What do you think Bitcoin's going to do?
Well, this is your expertise, not mine, but I will try to attempt to answer the question as best that I could. I think Bitcoin is going to follow the stock markets for the foreseeable future, like it has been. The breakout to $29 has largely mirrored the Nasdaq and the S&P 500 over the last couple of months, with a higher beta because Bitcoin is more sensitive to moves. I think the day Bitcoin completely diverges from the stock markets will be the day that we see Bitcoin adoption largely beyond speculation and investment from the retail and institutional side. If we start using Bitcoin as a currency, or if more smart contracts were to be built on layer one, then perhaps we'll see adoption for Bitcoin beyond a trading and investment vehicle. But for now, I think that's what the markets have shown that to be. I don't know if you have the stats to back this up. I don't know what percentage of Bitcoin is used primarily as an investment. Maybe you'll know, Ben. Um, but certainly, I think the markets have been pricing in that primarily Bitcoin has been used as an investment vehicle. So I think that correlation will hold. And so the question then goes back to, what do I think the stock market's going to do? And I think the stock markets, well, as the recession turns or hits, I think we're probably going to see a decline in equity value. I don't think we're going to get a huge crash down to like 90% crash, like some people have been saying, but I think we are going to get a decline. And keep in mind that any decline in the S&P and Nasdaq is going to be amplified in Bitcoin. So short term, it's very possible to get to 35,000, but I don't see us getting to 100,000 anytime soon. And I think that, I hope I'm wrong, but I don't see that happening anytime soon. I have heard the argument that because of the banking crisis, that there will be more Bitcoin adoption and that it's going to go to 100K sooner than expected. There might be some of that happening in the periphery of people moving their funds into cryptocurrencies, but more by and large, we've seen people move their funds out of banks, out of bank deposits into money market funds. There's this perfect inverse correlation between money market funds. I think you and I talked about this too. Money market funds and banking deposits. By the way, I want to show people this chart. Commercial deposits, St. Louis Fed. If people haven't seen it already, this is kind of what I'm talking about here. So if we take a look at deposits in commercial banks, rise in nominal value, rise, and then for the first time since the beginning of this chart, which is 1973, we're seeing a decline in deposits, meaning net withdrawals. And actually, if you take a look in percentage terms, it becomes a little bit more clear. And that's so it's obviously part of this is due to the fact that we're normalizing from this huge increase during COVID as people started putting more money into banks. But this negative decline has not been something that this trend has never been seen. I mean, we've had periods of zero or negative growth, where net withdrawals, but it hasn't sustained. So this is really unprecedented. The question is, where are they going? And I believe the answer is short-term CDs, treasuries, money market funds. So safe cash and cash equivalents, just not in banks. I haven't seen data to support that this withdrawal is going into Bitcoin. So the argument that because banks are on the verge of, where some banks have collapsed and so people are taking money out of their bank accounts and going to Bitcoin, I'm not seeing data to support that argument. And so I can't, and my camera just died. And so I can't see Bitcoin going up because of that. I can see Bitcoin going up if the stock market roars. And I think that one of the conditions for me to see the stock market do well during a period of entering into a recession is if the Fed pivots. So if I'm wrong and the Fed does pivot earlier than expected, then we could see a huge rally. But barring that case, I don't see any real or plausible scenario in which both the Nasdaq and the Bitcoin rally to new highs this year.
Do you talk some about money markets and whatnot, and I mean I think this goes for both of us because I think you said earlier that you're in your early 30s. I am as well. And one of the interesting things is that the risk-free rate hasn't really been this high, during our investing careers.
Mm-hmm.
Do you see fixed income investing right now as a viable way for people to invest? Earning say 5% annually in say CDs or in whether it's T-bills or whatever it is. Like, do you think that with rates as high as they are, it sort of opened up a new way to invest for people who haven't really, who for a lot of us, that we've been deprived of the risk-free rate for the better part of a decade?
It's interesting because I wasn't born in the 80s. I was born in the early 90s, but in the 80s, the risk-free rate was like 20%.
Mm-hmm.
Money markets rates in the early 80s during the Volcker days went up to like double digits. Didn't last very long, but you were getting like better than stock market returns today in a risk-free security, which is insane when you think about it.
Mm-hmm.
I think the question is how long rates will stay elevated. And like I said, I expect a pivot by next year when the recession hits. So I don't think rates are going to stay elevated at 5% forever. Maybe it'll come down to 3 or 4%, but I also don't think it's going to go back down to zero anytime soon. I think the end of zero interest days, the end of the days of zero interest rates rather are over for now. And I think that the Fed will likely embark on a monetary policy of 1 to 3% interest rates for the foreseeable future. That being said, I mean, if you were to ask me where to park my money right now in the short term for a risk-free asset, it would definitely be in treasuries and even high-grade corporate bonds. I mean, AAA corporate bonds have a very low risk of default. That's why they're AAA. But they're still at 6-7% interest rates right now, which is a very good return compared to something like gold, which yields nothing, and you actually have to pay to store it if you're buying physical. Well, you can also buy, a GLD ETF, which you don't have to pay for, but then you have to pay a management fee of a few bips. The point is, safe haven assets like gold are really in competition right now with yielding safe haven assets like treasuries. And so if I'm going to go somewhere, I'm going to pick something with yield, at least for the short term. I think that partly explains why money market funds have seen such huge inflows in the last couple of weeks, if not month.
Yeah, I think you've provided a lot of great answers, and I think this will be really great for the audience. The last question that I want to ask you is more of like a sort of like a general question about something. So, people, our generation, and I think this is something that a lot of people like our age are struggling with to some degree, are that we haven't really lived through a recession in the same way that, say, investors from a prior generation have. I mean, even the I mean, we had the 2021, of course, but it was so quick, right? And then when the Fed just printed our way out of it almost immediately, you have to go back to the financial crisis. But I mean, I don't know about you, but I mean, I was only 18 at the time. And in the dot-com crash, I was only 10 years old. So, these aren't really things like I can look at them on paper and I can see like, oh, like that looks pretty bad. But we haven't really experienced that sort of thing before. Not at least as, say, like adults who are investing, their own money in. So I guess my question is how do you navigate times like this? I mean, what are you relying on the most? Are you relying on historical data? Are you relying on, just sort of the momentum of various markets? I'm curious to know, like, what do you personally rely on during times like these when it seems like we haven't experienced this exact type of scenario or I guess we've never experienced this exact scenario, but we haven't experienced a scenario even remotely similar to this, in more than a decade.
I fully agree with you that people our age have been more or less insulated. I was also I think you and I are about the same age. I was also in high school during the '08 financial crisis, and I was in Canada So we had it even better than the U.S. Like the recession hit Canada a lot less than the U.S. So things were relatively good here compared to what happened south of the border. So coupled that with the fact that I was in high school, yeah, it basically had zero impact on my life because I was in university. Nobody around me were going out of jobs because everyone was, even adults, they were fine. The Canadian recession was more or less. The Canadian economy at the time was more or less fine. During COVID, the worst recession on paper, everyone was kind of just working from home. And so I had a steady job at the time. It didn't really affect me, right? It was obviously the lockdowns were a nuisance, but from an economic perspective, it didn't have any impact on me. How do I use? Well, we're really entering uncharted waters, aren't we? I mean, from a personal standpoint, sound personal finance advice I think holds. Try to pay off your debt as soon as possible. I think that advice is kind of overdue because I don't think interest rates are going up. So even if you have a lot of credit card debt, I don't think your interest expenses are going to go up from here if you don't pay them off. But yeah, I mean, I don't think interest rates are going to go back to zero anytime soon either. Anyway, I think they're going to stay elevated for a while, as the Fed funds rate historically has shown. That the chart that I showed you, they usually in the past has stayed elevated for 6 to 8 months before a pivot. So expect interest expenses to remain high if you still got a lot of personal debt. Try to pay that off. Yeah, save money. We're not entering boom times. We're entering not a bust either. It's not. I wouldn't call this a bust. I don't think we're going to get like 25% unemployment like the Great Recession, Depression rather. I don't think we're going to get 10% like 2020. Like 2008, and we're certainly not going to get anywhere near COVID levels. But I do think we have to brace for less aggregate demand overall, which may be good if you've already got a lot of money saved up because prices are going to, well, I don't think prices will come down, but they're not going to go back up anytime soon. I don't think inflation is going to return. So yeah, save money, pay off your debt. In terms of investments, I've looked into this. The best sectors that have done during the last two recessions have been consumer staples, utilities, things that you would intuitively think do well during a recession. So I looked into the best consumer staple stocks, and what I found was that Walmart actually outperformed every single recession since 1980. Walmart went public in 1970, October 1970, and the first recession its experience was 73 to 75. It declined 38% during that recession, but every subsequent recession, it's gained a return. I think let me just pull up this chart because I've actually done it. And I want to show. I'm not saying buy Walmart. I'm just saying that there are stocks that have consistently beat recessions. So these are all the recessions it survived since becoming public in the early 70s. You can see that in 81 it actually gained 109% over one recessionary period. And I think if you look at how it's performed over the last 20 years, every single recession has seen a gain. Great financial crisis, 9%, 8.5% during the tech .com bust, early 90s. This one, it was a very short recession during 2020, and there was a lot of competition from Amazon and other online retailers. So, but it still beat the markets, is what I'm saying. So if you're an investor, get defensive consumer staple stocks, things that people need regardless of the economic environment. Tobacco companies have also done quite well. Coca-Cola, another consumer staple. Walmart, I just showed you. So yeah, get defensive. I wouldn't lever up on crypto right now. I mean, feel free to disagree, but any asset with a high beta right now, I would stay away from.
Well, you're speaking to someone who never really levers up on crypto.
Okay.
I mean, I'll buy it at spot and hold it, but I'm not
Yeah.
I'm not that trader. But David, it's been a pleasure having you here. I think we'll go ahead and wrap it up here. Guys, if you're not subscribed to David, he's got a great YouTube channel, David Lin Report. I will link that down in the description below, and also make sure you follow him on Twitter as well. We'll link that in the description below as well. David, pleasure to have you here, and I look forward to seeing you again in the future.
Yeah, pleasure was all mine. And please, if you haven't subscribed to Ben's channel, like, what are you doing? Do that right now. He's got possibly the best technical analysis on crypto I've seen. Which is why I had you on my show. Yeah, well, that I've seen. True. I mean, So yeah, definitely check. I mean, you've got 700,000 subscribers from for a reason. So definitely check that out. And thank you for having me, Ben. I enjoyed that talk. I hopefully your audience finds that useful.
No, I think they will. All right, David. We'll see you next time.
All right, cheers. Thank you.